For 5 videos now, I have been telling you to do one thing. Invest. Buy assets. Put your money into the market and let the force of compounding grow it into a forest. And I bet, this whole time, a quiet little question has been nagging at you. But how? How does a normal person, someone with no special knowledge, no finance degree, no rich uncle, no idea what any of the numbers on those scary screens mean, how does a person like that actually invest without it feeling like gambling, without picking the wrong thing and losing it all, without needing to be some kind of genius who watches the markets all day? When most people picture investing, they picture something terrifying. Screens full of red and green numbers flashing, men in suits screaming into phones, charts that look like a heart monitor. They picture having to study companies, predict the future, time everything perfectly, and probably get it wrong and lose everything anyway. And so, because it looks so scary and so complicated, they just never start. The fear wins. And the force, the most powerful thing in money, the thing that could have built them a fortune, never gets to work for them at all. So today, I am going to take all of that fear and all of that complication, and I am going to throw it in the trash. Because here is the truth that the scary version hides. The single best way for an ordinary person to invest is so simple that a child could understand it. It requires no skill, no predicting, no genius, no watching screens. And here is the part that is going to genuinely shock you. This simple, boring, do-nothing approach quietly beats the vast majority of the expensive, suited-up professionals who do this for a living. The people who get paid fortunes to be smart about money, most of them lose to a strategy so simple you will be able to explain it to a friend by the end of this video. It is called an index fund. And once you understand it, the entire terrifying world of investing suddenly becomes calm and simple, and something you can absolutely do. I am Sprout. I started as a single coin, and I have spent this whole series telling you to plant your coins so they grow into a forest. Today, finally, I'm going to show you the single easiest, smartest way to actually plant them. So let's grow. First, let me explain what an index fund actually is. And I am going to do it exactly like I promised, like you are 5. Let's start with what most people think investing is, so we can see why it is so risky. Most people think investing means picking a company. You look around, you think, I bet this one company is going to do great. And you buy a piece of just that one company. And maybe it does great, and you win. Or maybe it doesn't. Maybe it struggles, or a competitor crushes it, or the whole thing falls apart, and you lose. Picking a single company is like going to a race and betting everything you have on one single horse. If your horse wins, amazing. But if your horse stumbles, you lose it all. That is not really investing. That is gambling. It just wears a nicer suit. Now here is the index fund. Instead of betting on one horse, what if you could bet on every horse in the race all at once? What if, with a single purchase, you could own a tiny little slice of hundreds or even thousands of companies at the same time? That is exactly what an index fund is. It is one single thing you can buy, but inside it, it holds tiny pieces of a huge number of different companies, all bundled together. So when you buy one share of it, you instantly own a sliver of all of them at once. Let me give you the most famous example. You have probably heard of something called the S&P 500. It sounds fancy and complicated. It is not. It is simply a list of around 500 of the biggest companies in America, the giants. The household names you interact with every single day. And you can buy an index fund that holds a tiny piece of all 500 of them at the same time. So with one simple purchase, you become a part owner, a tiny, tiny part owner of 500 of the biggest, most powerful companies in the country, all at once. Let me make that real with actual money for a second. Say you put $100 into an S&P 500 index fund. That $100 does not go into one company. It gets quietly split into tiny pieces and spread across all 500 of them, roughly in proportion to how big each company is. So, a few dollars of yours might go toward the biggest tech giant, a few cents toward a smaller company near the bottom of the list, and so on, all the way down. With $100 and one click, you now own a microscopic sliver of 500 businesses. And when those companies as a whole make money and grow, your little slice grows right along with them. You do not have to do anything. You do not have to choose which ones. You do not have to watch them. You just own a tiny piece of all of them, and you grow as they grow. That is the entire thing. It is ownership of the whole economy, made simple enough to do from your couch. And now think about what that actually means for your risk. When you owned just one company, your whole future was tied to that one horse. But when you own 500 of them, if a few of those companies struggle, or even completely fail, who cares? They are a tiny slice of the whole thing, and the other hundreds of companies are still chugging along, still growing, carrying you forward. You are no longer betting on any single company surviving. You are betting on something much, much safer. You are betting that the overall economy, all those companies together, will keep growing over the long run. And here's the thing. Over the long run, for more than 100 years, through wars and crashes and disasters and recoveries, it always has. There is an old saying in investing, do not put all your eggs in one basket, because if you drop that one basket, all your eggs break. An index fund is like automatically spreading your eggs across 500 different baskets, instantly, with a single move. Drop one basket, lose a few eggs, no big deal. You are protected. Not by being clever, but by being spread out. That is the magic of it. Safety through owning a little piece of everything. Okay, so that is what it is. Now let me show you the part that genuinely shocks people. Why this boring little thing beats the experts. Because you would think, wouldn't you, that the smart move is to hire a professional. Someone whose whole job is to study the market, pick the winning companies, dodge the losers, and beat the average. There is a whole giant industry of these people. They are called active fund managers. They are highly educated, they work incredibly hard, they have powerful computers and teams of analysts, and they charge you good money for their expertise. Surely they can beat a dumb basket that just owns everything, including all the bad companies, right? Wrong. And this is one of the most well-documented, most surprising facts in all of finance. Over long stretches of time, 10 years, 20 years, the vast majority of these expensive professional managers fail to beat a simple index fund. Not some of them, the vast majority of them. Year after year, study after study, the boring basket that just owns everything quietly beats most of the geniuses who are paid fortunes to outsmart it. How is that even possible? How does doing nothing beat an army of experts? There are two big reasons, and you need to understand both. The first reason is simple. Predicting the market is incredibly, almost impossibly hard. Even the smartest people on Earth, with the best information, cannot reliably guess which companies will win and which will lose, or when the market will go up or down. They get it right sometimes, and wrong sometimes, and it mostly washes out. Nobody has a working crystal ball, not even the pros. So all that effort to pick winners, mostly just amounts to expensive guessing. But the second reason is the one that really matters, and it is the silent killer. Fees. Those professional managers charge you a fee for their expertise every single year. And it might sound small. They might charge you, say, 1 or 2% a year. 1%. That sounds like nothing, right? But you and I just spent a whole video learning about the force. Compounding. And here is the brutal twist. Compounding does not just work on your money, it works on the fees too. That 1% taken out every single year for 30 or 40 years while your money is trying to grow. It does not cost you 1%. Over a lifetime, it can quietly eat away a huge chunk of your entire fortune. A massive piece of the forest. Gone, not to a crash, not to a bad bet, but simply to fees, drained out a little at a time, year after year. An index fund, on the other hand, does not need a team of expensive geniuses trying to guess the future. It just owns everything and sits there. So its fees are tiny. We are talking a tiny fraction of what the active managers charge. And that difference, the expert charging you a meaningful slice every year versus the index fund charging you almost nothing, compounds over your lifetime into an enormous gap. So you, doing nothing, paying almost no fees, owning a piece of everything, end up beating the expert who charged you a fortune to underperform. Let that sink in. The boring, cheap, do-nothing option wins. Not despite being simple, partly because it is simple. There is a famous story about this. One of the most respected investors who has ever lived, a man worth tens of billions of dollars, made a public bet. He bet a large sum of money that a simple, boring index fund would beat a collection of elite, high-priced professional funds over 10 years. The best minds in the business, with all their tools and tricks, against one dumb basket that just owns everything. 10 years later, the boring index fund won. And it did not just win, it won decisively. The geniuses lost to the basket. That is how powerful this idea is. The man who knows more about investing than almost anyone alive bet on simplicity. And he was right. Now, I promised you honesty in every video, so here comes the twist. And it is an important one. Because if the index fund is so simple and so powerful, you might think, great, this is easy. I will just buy it and become rich. And the strategy is easy. But there is one part that is genuinely surprisingly hard. And it is not the part you think. The hardest part of investing in index funds is doing nothing. I am serious. The strategy is the easy part. You buy the index fund regularly, and you leave it completely alone for decades. That is the entire plan. Buy and wait. The problem is that human beings are terrible at doing nothing, especially when it comes to their money, and especially when they are scared. Because remember what we learned about the market. It is bumpy. It does not go up in a nice, smooth line. It goes up over the long run, but along the way, there are crashes. There are years where you open your account and it has dropped, and the news is full of doom, and everyone around you is panicking and selling, and every single instinct in your body is screaming at you to pull your money out before it all disappears. That is the hard part. Not the buying, the holding, the sitting still through the scary parts. Let me make that fear real, because you will face it, and I want you ready for it. Imagine you have been investing for a few years, and you have built up a nice amount. And then a crash hits, a big one. You open your account, and a big chunk of it appears to be just gone. On paper, you have lost a lot. The news is screaming that this is the end. Your coworkers are panicking. Maybe someone you know just sold everything in a panic. And there you are, staring at that red number, feeling sick, with every cell in your body begging you to make it stop, to sell, to save what is left. This is the moment. This is the exact moment that decides whether you build wealth or not. And here is what you have to remember, burned into your mind. It is not a real loss until you sell. As long as you hold, that drop is just a number on a screen. A temporary dip on a chart that, given enough time, has always climbed back and gone on to new highs. The people who held through every crash in history came out the other side richer. The people who panicked and sold at the bottom locked in the loss forever. So do not sell the dip. Hold, breathe, keep buying. The recovery always comes for those patient enough to wait for it. And this is exactly why most people fail at investing, even when they know the right strategy. It is not a knowledge problem. It is an emotional problem. They panic at the bottom, they sell when prices are low, they lock in their losses, and then they are too scared to get back in, so they miss the recovery that always, eventually comes. They let their fear make the decision, and fear is the worst investor in the world. The people who actually get rich from index funds are not the smartest. They are the calmest. The ones who can look at a crash, remember the chart, remember that the market has recovered from every single crash in history, and simply do nothing. Hold on, keep buying, and let time do its work. Boring, patient, unshakable. That is the whole skill. And here is a little piece of magic hidden inside buying automatically every month, through the ups and the downs. It has a fancy name, dollar cost averaging. But forget the name and just watch what it does, because you are buying the same amount of money's worth every month, no matter what. When prices are high, your money buys fewer shares. And when prices are low, your money automatically buys more shares. So you naturally end up buying more when things are cheap and less when things are expensive, without ever having to think about it, or time anything, or be clever. The crash that terrifies everyone else? For you, quietly buying every month, it is just a sale, a chance to scoop up more of the same thing at a discount, automatically, while everyone else is panicking and running for the exits. Over time, this smooths out the bumps, and it means you never have to worry about whether today is a good day or a bad day to invest. Every day is just another automatic purchase. The scary, unpredictable bumpiness of the market, the thing that destroys the people who try to time it, actually works in your favor, as long as you are calm, consistent, and automatic. So now let me give you your move, the actual steps, and you will see it is almost insultingly simple. Step 1. You need a place to buy investments. This is called a brokerage account, or you might use a special retirement account. For now, just know that opening one is about as hard as opening a bank account. It is free, you do it online, it takes maybe 20 minutes. I'm going to make a whole separate video about the specific types of accounts and which to use, so do not get stuck here. Just know that the door is easy to walk through. Step 2. Inside that account you buy a broad, low-fee index fund, one that owns a huge slice of the whole market, like the S&P 500 we talked about, or an even broader one that owns basically the entire market. And just so you are not paralyzed by choice, let me keep this simple. You will mostly hear about a few kinds. There is the S&P 500 kind, which owns the 500 biggest American companies. There is the total market kind, which owns basically every public company in the country, big and small, all at once. An even wider basket. And there are international ones, which own companies from all over the rest of the world. You do not need to agonize over this. For most people just starting out, a broad one that owns the whole national market, or the famous S&P 500, is a perfectly solid, boring, excellent choice. Some people like to own a mix of a national one and an international one so that they own a little piece of the entire planet's economy. We will go deeper on exactly how to choose and combine these in a future video. But please, do not let the choice freeze you. Owning a broad, cheap basket of almost anything beats sitting on the sidelines owning nothing at all. And here is the one thing to check, the one number that matters: the fee. Make sure the fee, sometimes called the expense ratio, is tiny, a tiny fraction of a percent. The good, boring index funds have fees so small they are almost nothing. That is what you want. Low fee owns everything. That is the whole checklist. Step 3. And you already know this one because it is the same move from every other video. Automate it. Set up an automatic investment so that every month a set amount of money goes in and buys more of your index fund all by itself. No matter what the news says, no matter how you feel that day. When the market is up, fine, you buy a little. When the market is down, even better, you are buying the exact same thing on sale. This automatic, regular buying has a fancy name, but all it really means is that you are removing your panicking human brain from the decision entirely. The system just keeps calmly buying through the good times and the scary times, while your emotions sit on the sidelines where they belong. Step 4. The hardest step. Do nothing. Leave it alone. Do not check it every day. Do not fiddle with it. Do not panic sell when it drops. Do not get greedy and gamble when it soars. You have built a calm, boring, powerful machine. Now, your only job is to keep feeding it and to not get in its way. Let time and compounding do the rest. For years, for decades. That is it. Now I can hear the fears, because everyone has them when they are about to start. So let me answer the big ones quickly. Fear 1. What if I invest and the market crashes right after? Here is the answer. It might. Honestly, it might. But remember the chart, and remember that you are buying automatically every month for decades. A crash early on is not a disaster for you. It is a gift. It means you get to spend years buying cheap before the recovery comes. The only people crushed by crashes are the ones who panic and sell. You are not going to be one of them because you now understand the game. Fear 2. Isn't now a bad time to start? Everyone always feels like now is a bad time. When the market is high, they think it is too expensive. When it is low, they are too scared. There is never a moment that feels safe. And that is exactly why the answer is to ignore the feeling, start now, and let the automatic, monthly, decades-long machine handle the timing for you. The best time to plant a tree was years ago. The second best time, as always, is today. Let me bring this home. You spent your whole life thinking investing was this scary, complicated thing for geniuses in suits. It is not. The single best way for a normal person to invest is to buy a boring basket that owns a tiny piece of everything, pay almost no fees, automate it, and then leave it completely alone for a very long time. That simple, calm, do-nothing approach quietly beats most of the experts who get paid fortunes to be clever. You do not need to predict the future. You do not need to pick winners. You do not need to be smart or rich or lucky. You just need to own a little piece of everything and have the patience to wait. Remember, all the way back in our second video, when I drew you that chart? When I showed you how a single $1,000 could grow into a small fortune over 30 years, just from the force of compounding? Well, the index fund is how you do that. It is the simple, real-world tool that puts that whole magical chart to work for you. The force needs a vehicle, and this is the calmest, cheapest, most reliable vehicle an ordinary person has ever had. You finally have the how. Now you can actually plant the forest. But there is another number, quietly running in the background of your entire financial life, that I have mentioned a couple of times now and promised to explain. It is a number you might not think about much, but it follows you everywhere. It decides whether you get approved for things. It decides what interest rate you pay when you borrow. And over your lifetime, a good one versus a bad one can be worth a genuinely enormous amount of money. Most people have no idea how it actually works, which means they are accidentally hurting it without even realizing. In the next video, I'm going to pull back the curtain on your credit score. What it actually is, how it really works, the simple things that quietly build it up, and the mistakes that secretly tear it down. Because once you understand this hidden number, you can make it work for you instead of against you. And that alone can save you a small fortune. I am Sprout. You just learned how to plant the forest. I will see you in the next one.